Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon and financial mumbo jumbo. Today we're diving into an amended report from LuxExperience B.V. It seems like they had a little oopsie and needed to correct some numbers. So let's see what changed and why it might matter. And hey, if you like getting the real scoop on company filings, make sure you are subscribed. We also have a Discord community linked in the description below, so come hang out. So what is this amendment all about? Basically, LuxExperience is going back and tweaking some figures related to their shares outstanding for the period ending the 31st of December 2025. It is like finding a typo in your homework and having to hand in a corrected version. The numbers themselves tell a pretty interesting story. For the last 3 months of 2025, the reported number of shares outstanding jumped from about 87 million to over 140 million. That is a huge increase, a jump of over 50 million shares. Think of it like this: if your company was a pizza, they just added a lot more slices to the same pizza, meaning each slice is now smaller. This directly affects how they calculate earnings per share. The same adjustment applies to the 6-month period ending the 31st of December 2025, where the shares outstanding went from around 87 million to almost 140 million. This kind of adjustment usually happens when there is a significant event like a stock split, a big stock issuance, or perhaps the conversion of certain financial instruments that create new shares. This also means that the earnings per share figures are getting a makeover. When you have more shares out there, the earnings for the company are spread across more owners, which typically makes the earnings per share go down unless the company's overall profit has increased significantly. It's crucial for investors to see these numbers corrected because it gives a more accurate picture of profitability on a per share basis. This is especially important when you are looking at performance for the second quarter of their fiscal year 2026. Now, even though the main update is about share counts and earnings per share, the filing lists a lot of other elements. This includes things like different incentive plans, for example, the Supervisory Board Members Plan, which had activity around late 2024 and throughout 2025. They also detail stock options under their long-term incentive plans. These are often granted to key employees and executives with vesting periods that can span several years. We see mention of these grants for other programs like alignment grants and restoration grants, with activity noted across different periods in 2024 and 2025. Then there are restricted stock units, or RSs, tied to non-market performance. This means their payout isn't directly linked to the stock price itself, but rather to company-specific goals, which is a common way for companies to incentivize performance against strategic objectives. Looking at how the company operates, they break down their business into various operating segments. We see classifications like luxury footwear and accessories, and other segments like off-price, luxury nap and MRP, and luxury mytheresa. This segmentation helps investors understand where the company is making its money and how different parts of the business are performing. The luxury mytheresa segment seems to be a key area, with performance tracked across different quarters in 2024 and 2025. It is good to see these segment details because it allows us to look beyond the overall company figures and see which specific businesses are driving growth or facing challenges. They also provide a geographical breakdown with segments for the United States, Great Britain and Germany, along with a rest of world category and Europe excluding Germany and United Kingdom. This shows us where their customers are located and how they are performing in different global markets. When we look at financial liabilities, the mention of revolving credit facilities is noteworthy. These are flexible lines of credit that companies can draw upon as needed. Their inclusion suggests the company is managing its short-term liquidity needs through these facilities. They also list guaranteed senior secured fixed rate notes. These are a form of debt that have specific terms and are backed by assets, indicating another layer of their financing structure. Lease liabilities are also detailed, which is important under current accounting standards. Companies now have to report most leases on their balance sheets, giving a clearer picture of their long-term commitments. We see both current and non-current lease liabilities reported. Then there are other current liabilities, which can encompass a wide range of short-term obligations. This often includes things like accrued expenses or taxes payable in the near future. On the asset side, we see financial assets accounted for at amortized cost. This includes typical current assets like trade and other receivables, meaning money owed to the company by its customers. And of course, cash and cash equivalents. This is a fundamental metric showing how much ready cash a company has on hand to cover its immediate obligations and invest in opportunities. There is also a mention of Outnet Disposal Group held for sale under discontinued operations. This indicates that the company is planning to sell off a part of its business, specifically the Outnet, which is a significant strategic move. This often means that the financials for this division are being presented separately because it is no longer considered part of the ongoing core business. And finally, the previously stated member entries suggest restatements of prior periods, which aligns with the overall theme of adjustments and corrections in this filing. So, what is the big picture here? LuxExperience B.V. is making some significant adjustments to its reported share count, which directly impacts earnings per share. This is a critical correction for investors trying to understand the company's profitability on a per-share basis, especially for Q2 of fiscal year 2026. The underlying operational data, broken down by segment and geography, gives us a good look at their diverse business structure, from luxury goods to off-price models. The planned sale of the Outnet is a major strategic decision that will reshape the company's future. While the exact reasons for the share adjustment aren't fully detailed in this amendment, it is a reminder that financial reporting can be complex and sometimes requires corrections. Overall, LuxExperience appears to be actively managing its portfolio and capital structure. But investors should always pay close attention to these adjustments and understand their implications for per-share metrics. Alright, that is our breakdown of LuxExperience's amended filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.